Hey, what's up, guys? Welcome to the Inside View Real Estate Podcast. We have a very special guest today talking about high interest rates and how to combat those things and save you guys a little bit of money. You're going to want to tune in. I will see you on the inside. Hey, good morning, good afternoon, or good evening, no matter what time it is. I hope that you guys are having an amazing day. I'm here with Mike Burke from JFQ Lending, and we're talking about the interest rates are kind of fucked up, dude.
Yeah. I apologize to our audience about that. I wish there was something I could immediately do.
It's all your fault.
You know,
it is all
but
your
we're going to
fault.
work through it.
Yeah, so like I remember it was like a Friday to Monday. It was like literally, dude, what happened to the mortgage-backed security market? Because it just got jacked up.
So that was a couple weeks ago, right? And we saw a 250 basis point adjustment within 2 business days.
What is basis?
So that's a big fancy way of saying things got real wild real quick.
Okay.
And call it a percentage, right? So 2.5% of whatever loan amount you were going to buy is now an additional fee for you as a borrower on top of your closing costs.
Hang on. All right, so let's do some math on this.
Sure.
I'm kind of slow. So if I've got a $500,000 loan and you're saying that it went up 2.5 points.
That's right.
So you're saying that's $12,500.
You're not that bad. $12,500, right on the nose.
Okay, cool.
Yeah, that's a lot.
But that's in fees, dude. That's just to get my mortgage?
Correct. So if you kept the rates the exact same as the previous day, you'd pay $12,500 extra on that loan amount. Or what most folks see or what the news follows is rates went crazy and rates went up, right?
Right.
So what a lot of consumers don't know is that the rates are the same pretty much every day. They're there. It's the cost of financing that changes day to day.
Gotcha.
So yes, what that ultimately means is that you're probably as a consumer going to opt for a higher rate so you don't have to cut a check for that $12,500.
So you're saying I can still get like a 3% loan?
Down?
No, 3% total. Like,
interest
I want to pay
rate.
3% interest rate. Is that possible?
No, sorry.
It's really expensive.
Yes. Yeah, I'd like to buy a Corvette for the same price they were for sale in 1987, but
not happening.
That's kind of where we're at when it comes to mortgages, isn't it?
100%. So what is like an average rate today on a 30-year fixed?
So it depends, right? So there's 3 buckets of lending, I always say, right? So you've got your big box lenders, big retail lenders, right? That you know by name, that you see their commercials on ESPN and other networks.
Failure to launch mortgage.
Sure. Okay. So so there's those, right? And then you've got your broker world. Okay. A lot of brokers will work with just one investor.
Gotcha.
Right? An investor is the person that you're probably going to be paying your payment to. Maybe they service your mortgage, things like that.
Okay.
And then there's some other creative solutions like where I work at JFQ Lending. We are what's called this correspondent lender. Mm-hmm. So we work with 13 different avenues of investors, which gives us all sorts of different rate sheets, pricing, products, creative solutions to go ahead and help folks save money in these high rate environments.
Okay.
But to answer your question directly, what's an average rate right now in a conventional loan?
I'm not going to hold you to it, dude.
Probably going to be somewhere in like the low 6s, high 5s, depending on your equity position or down payment on a purchase.
Gotcha.
Government loans, VA, FHA, a little bit lower than that. So you'll see maybe a 0.5 to 5/8% drop on those on average.
Gotcha. In APR disclosures, like, don't hold us to this shit, right? So like it changes every day. Like,
sure.
Got to call and get a quote.
Right. And of course, you know, you could always go lower than that by paying points or a premium upfront interest, right?
Yep.
Or save on some costs by going the other way.
So like, what are some things I could do right now as a consumer to maybe save some bucks on my mortgage? Is it like credit score driven? How's that model kind of, is it reserves? Am I trying to like put more money down? Like, is there a structure there that works? Like, is there an inflection point in my credit score where you're like, hey dude, if you have a 620, you're going to get this. But if you have a 640, you're going to get this. Like, is there, like, what is that threshold?
Sure. So good point, the way you're thinking about it, right? So there are tiers on all sorts of stuff, right? So primarily credit score is going to impact the pricing more than anything. Second is going to be your loan to value.
Okay.
So if you have a lot of equity, loan to value is going to be the amount you owe on a property versus how much that property is worth, right?
Okay. So for example, like getting a $400,000 loan on a $500,000 property.
Yep.
80% loan to value.
Sure. Okay. So then you've got 20% equity position, lenders, investors, et cetera. They look at that as a lower level of risk. So therefore you have a little bit better pricing break.
Gotcha.
Right? So if you put, simply put, I always tell clients when they call in, before you and I spoke, you knew if you had a really good credit score, you probably get a better deal than someone that called in with the 500s. Mm-hmm. Same thing with somebody who has 200,000, 300,000, 400,000 in equity, right? So if you have both of those things going for you, you can tag into some rates right now that are maybe high 4s, right? Right now on government loans especially, right? Which is a beautiful
FHA,
thing.
VA. Mm-hmm. Yep, that's killer.
Yep, so they're still there.
So like, well, let's talk about credit score for 2 seconds.
Sure.
What are some things that you can do right now to help? Like, do you do rapid rescores?
We do.
Okay.
Yep.
Can you explain that process?
Sure. So rapid rescores are pretty straightforward, right? So you have a snapshot of someone's current situation on their credit profile, aka how much do you owe today, and how much is your line of credit, for example, on a credit card. And we can do hypothetical situations. So if you paid down your Citibank card, you have a $4,000 limit, you owe $3,000, let's knock it down to $2,000. And then that'll go ahead and change the percentage that you have of debt versus the line of credit. And that balance that you have can really help out, right? So
yeah, so like I'm gonna give somebody a credit hack here.
Sure.
So like I used to have probably like a 400 something credit score, legitimately.
That takes a lot of work. That's just as hard to get as an 820.
It was pretty fucked up, right? Like I had collections and a lot of bad shit going on,
Yeah.
and a repo and some different stuff. And so one of the things that I noticed that they always say that 35% of your credit score is made up of your revolving debt or something like that. You know, the credit ratios.
Yep.
Dude, it's like the very last 35%, you know, because it's crazy. And I do it all the time. I, you know, do a lot of construction projects. I'll use all my credit cards to get the points, and then I'll pay them off the next month, not paying any interest. But if it's the statement date and it comes out and there's a balance in those credit cards, dude, I usually hover like 814, 800 something credit scores. And I see that thing drop down to like low 700s just with carrying a balance.
Quick.
I'm talking like 100 points in my FICO. Quick, you know. And so pro tip, like pay off all your consumer credit. And you should be doing that anyway because inflation and, you know, interest rates are rising.
For sure.
So as interest rates go up, that credit becomes very, very expensive on a variable rate. So pay off those credit cards immediately. Like that's the first thing you should be doing. Stop investing. I said that in a previous podcast. Stop investing in the stock market and, you know, like just pay off your high variable rate. You know, it's really hard to beat, you know, 25% interest in the market.
Well,
you just can't do that shit.
Compounding interest is either your best friend or the devil, depending on which side of the transaction you're on, right?
100%.
So there's a ton of truth there. And, you know, you hear about these ratios of what that balance should be and where you really get the best break. Under 50%, you hear a lot. I've personally seen that if you get it under like 40, so if you owe, or you have a line of credit, of 10,000 and you owe under 4,000, that can give you a really, really big pop in a good way to go ahead and get that number. Yep. And then of course, no debt's better than any debt when it comes to that and the qualifications.
Absolutely. Yeah, that's crazy. Is there anything we do as far as like real estate agents in terms of buying down that rate? So like, you know, I was in the mortgage business for a long time. And what we would do is say, hey, the par rate where it's not going to cost you points, I'm just going to throw a number at 6%, right? But wait a minute, if I pay half a point up front, you know, in fees on the loan amount, well, I can buy the rate down to like 5.75%. And so I'm doing the math in my head. I'm like, wait a minute, I'm going to pay a quarter less over the life of the loan if I just pay a half a point up front now. Is that something I can do still?
You can certainly pay points to go ahead and get lower interest rates. And I want to hit pause for a minute and just go back, right?
Yeah.
Because the word points, there's someone right now, someone out there is looking at us and saying, points, who pays points? Points are the devil inside of mortgages. Points are bad, right? It's bomb on an airplane. It's like a trigger term that sets people off in a negative way when it comes to financing. That's just simply not true. It's not true. There are good deals when it comes to buying points and prepaid interest. And there are certainly deals that just don't make sense where the premium's certainly too much and you should leave it alone.
Yeah.
But what you need to look at is you need to look at how much am I paying for a one-time fee, because that's what points are, right? So just to simplify it, the way that I would love every consumer watching this, or agent for that matter, is replace the word point with percent.
Okay.
So if you pay 1 point, you're paying 1% of the loan amount one time to get access to those lower rates.
Yes.
So simple math. You get a 30-year mortgage. You're going to pay 1% one time to save 0.5% 30 times over a 30-year mortgage. Good deal, bad deal?
Great deal.
Huge,
right?
But sometimes I have folks that are reserved and they're like, nope, points are a bad idea, right? Now, if the market's going down, 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 they are probably correct in that assumption, because you can always refi. You can get the lower rates later for cheaper, right? Right now, there's just a lot of uncertainty. You know, no one has a crystal ball. My opinion, I think that we're going to see rates plateau a little bit, hang out, probably go as the Federal Reserve raises them, hikes them a couple more times on us. Nothing crazy, hopefully, fingers crossed, knock on wood. And then I could see in 2023, we start to see a lot of fall off as we see some of the economic change happening out there, where if the big squeeze is happening, and
for sure,
and something's got to give.
It has to. You know, history repeats itself often, you know, so we've seen this play out before.
For sure.
You know, and so I do think that this is a temporary problem. I do think that it'll be a transitional thing, but, you know, beware of like what you're going into. And so, you know, I hate when people just give up straight advice and there's like no context to it.
Sure.
You know, so like get a hold of one of us and start talking context. Because if you're in a situation you're like, hey, dude, I kind of got to buy something soon, or I get a rent, getting into a mortgage that has a fixed payment every single month is a really good hedge against inflation, against rising rents, right? And so like when there's a lot of inflation, what happens? Rents tend to go up because things get more expensive. Landlords see opportunity to get more cash, and they're like, why wouldn't I do that? And so we're seeing that right now, and we're seeing that squeeze. So, come and talk to us and just say, hey, look, here's a scenario. Is it a good time? And
here's what I'll tell you too, Carl, is there's a lot of folks out there in the world that maybe do a lot more transaction than others, and they feel pretty well versed in either real estate or lending and whatnot, as a buyer, as a seller, et cetera. The market, the amount of change that we've seen, both in the housing market and the lending market, just in the period of a short few weeks, I keep telling my loan officers we're in a time machine, right? If you talk to me today versus 7 days ago versus 2 weeks ago, I'm going to have extremely different advice week to week, day to day, darn near, because of the amount of change that we're seeing, like that Friday, Monday situation that you brought up earlier.
Yeah, I mean, I've never seen that. I've been in the business for 22 years, dude. I made it through 9/11. I remember the rate sheets right after 9/11.
Yep.
The markets opened back up on like that Monday after. And dude, it was like a substantial, like we're talking like 250 basis points or more.
Yep.
And then we kind of, regained our sanity, and we're like, oh, wait a minute, everything will be okay. And then we came back down and we saw rates back in the low sixes again, and, kind of just kept moving. And so, we're talking about paying 6% on a mortgage, guys. That's not unheard of. I grew up in an era where rates were 13%, and so I got into the business when the rates were around 8%.
You and I were having a conversation the other day, and I really love something that you talked about. You mentioned how the current rate of inflation versus maybe some of the debts that you have, and how to change your mindset about what's expensive versus
totally
what you're really paying for what you have, right?
You know what, Dave Ramsey, very good intention, right? But I think some of his advice could be a little bit skewed. I'm of the opposite thinking, where I like to borrow other people's money at cheap rates. And so, for example, like if I'm borrowing money at 6%, but inflation is what they're calling 8% hypothetically, which is like 15 or 20 or higher. But if inflation is 20% or 15% or 8%, but I'm borrowing money at 6%, the money I'm paying back that loan at is worth less. And so like I'm getting free money. Matter of fact, I'm getting money and they're paying me to take it. And so that's smart as long as you're buying the right assets.
Sure.
Right? And so that's a whole different conversation. But there's an advantage here.
I think perspective really, it can be skewed one way or another, and you can really write whatever storyline you look at. So it's important that you're looking at things objectively right now, right? Like,
for sure.
Do my decisions inside of finance make sense for my situation and the outcome, right? So for my loan officers, I run a large group of loan officers, and we have the opportunity to talk to a lot of prospective clients that are looking to go out and make moves. And the advice is different for everyone's situation, right? So if somebody is rent-free right now that's listening to this, and maybe you're living with mom and dad, you're living with mom and dad, and you are in a career and you're able to save some money right now, and you want to see what happens over the next 2, 3, 4 months, that might not be a bad idea right now. I'm not going to hard sell someone into making moves just because I'm in that business. I care about people's goals and what they're trying to accomplish and how that pans out for them long-term, right?
Yeah, for sure.
On the other hand, if you're in Scottsdale with us, your rent just went up $600 for a 2-bedroom, and it only has prospects of going up even more in 2023. It's probably time to buy if you have the ability to do so, and you're not going to put yourself in a precarious position.
100%. And there's tax advantages. And, one of the things that I always talk about is just, protection against inflation, right? So before we go, one of the things that you really hit on before this, because we talk off camera a lot, is what do you get approved for?
Oh, yeah, good point. I think it's a big one, right? So a lot of folks historically, when you talk about a pre-approval letter, a pre-qualification letter, everyone inside the industries of realty and lending, and then, of course, the consumers, the buyers, they're all talking about loan amounts, right? Like, hey, I'm approved to buy a home for $500,000, $700,000, whatever that number might be. And although that is the intention and that is technically true at time of taking the application, there's something called a qualifying rate, right? So your loan officer is using that day's interest rates to go ahead and qualify you for that purchase. And then that outcome is that loan amount, right?
Yep.
The reality is what they're qualifying you for that does not change regardless of interest rates going up or down. You're really qualified for a housing expense and a dollar amount on that payment, including your PMI, including your homeowners association if you have one, anything like that, condo dues, right? So in an instance like we were talking about for that gnarly Friday, Monday combo we ran into, a lot of folks found that maybe $100,000 of buying power just fell off. And you don't want to be upset at your loan officer or your agent, right? It was a very unique one-off thing that hasn't happened since 1986, to put things into perspective.
87.
Yeah, was it 87?
87.
There you go.
Today.
Yeah, unbelievable. Yep. So let's not get too angry at these folks. Just understand, hey, there was no one's intentions. It's just we've never seen a swing like that in decades and decades, right? So, but I share that with you because as a buyer, so important that you know, hey, I'm approved for $2,700. Know what that qualifying rate is. And if you want to check in with your loan officer, it could be as simple as a text message once every 2 weeks. My best advice to you is when you go to put an offer in on a home, the day you go to write one up with your agent, next call, immediately call your loan officer, give them the address, right? Let's talk through how much of the taxes on the property. Maybe the HOA, we talked about this with Optima, right? Yeah. What are the condo association fees there?
Ridiculous, dude. And I bought in there and they were like $330, and guess what they are now? Like almost 3 times that. That's just insane.
Yeah.
So,
and when you talk about if something's $500, $600, $700 for your association, like if you're in Florida, for example, and you're listening, that this may very well be your everyday situation. Those high-rise condos, that's what people pay to live there.
Yeah.
Right. But that $500, that could be the difference of upwards of $100,000 of buying power,
depending on the purchase rates. Yeah, 100%.
So something to consider.
Cool. Anything else you should leave the listeners with?
Just, hey, stay in it, stay strong. Don't get that buyer burnout, right? Just keep your end goal in mind. At the end of the day, you either want to become a homeowner, you want to have a place to call your own, you want to have that ability to have that autonomy and make moves down the road without someone else dictating your housing expense, which is a pretty scary situation for rent. And then lastly, refinancing. Refinancing is one of those other words that some people are totally on board and they love it. Others maybe just don't know enough about it because you're buying your first home. Refinancing is not the same experience as buying a home when it comes to the normal stressors of buying a home. What I mean by that is you're always going to worry about, is the appraisal going to come in, right? That's a worry that's normal. Is the AC unit really in good condition? Is the roof really what it's cracked out to be? Or is there anything being hidden on this property, right? So that's normal, and that's going to be every purchase no matter what, even if it's your 50th house.
Yep.
Right? From there, though, refinancing, all that gets shelved. You're already in the home. You own the collateral, and you're in a position, if you're like a W-2 employee, for example, you're not self-employed, typically what my loan officers need to go ahead and refinance your home is your 2 most recent pay stubs, your 2 W-2s, and a driver's license.
Yep.
That's the most common 5 documents that we need. And I'll tell you, the majority of the time, over 50% of the time, you don't even need an appraisal if you're doing just a rate and term reduction of your interest rate. So I share that because let's get you into a home if right now is the right time. And then 6 to 12 months from now, find a great lender that you trust, go ahead and move forward, and then address that payment, knock it down by X amount of dollars at that point.
Yep, JFQ Lending.
Hey,
shameless plug. So cool. Well, thank you so much for joining us.
Of course.
Hey guys, if you haven't done already, please like and subscribe. Really appreciate you guys tuning in, and I hope to see you very, very soon. Take care.
Hey guys, thank you for tuning in to today's episode. Make sure you like, comment, share, subscribe, do all the things. We want to continue to bring value to you every single episode. But until next time, see you on the inside.